What to look for when purchasing a high cash value life insurance policy. If you've ever been shown a cash value life insurance policy, if you're in the market for one right now, really the question to ask yourself when you are looking at all the options, trying to understand exactly how this works is, what should I look for? So we're going to show you in this video what to look for, first from a simplified standpoint, and then we're going to start to break things down further, looking at the numbers, different riders and such. This is really this video, I should say, will equip you with the knowledge you need to know as far as the basics on how to set up a policy if we're an agent in the business, or if we are looking for a policy as a consumer, what we can instruct our agent, if you're working with us or any agent, on exactly how to set up a policy. And we do have businesses that provide services to both those in the industry, agents, and also consumers, setting up and working with you over the life of your policy. So let's get into it. We've got a goal of maximizing cash value. What should I look for? Here is the first thing. When we are setting up a policy, if we are maximizing the values, we should see a first year cash value between 80 and 90% of what we pay in the first year. So for example, if I am paying in $10,000, I should see somewhere between $8,000 and $9,000 in the first year. If I'm paying in $100,000, I should see somewhere between $80,000 and $90,000 in the first year. Now, what I will add is if this is a high early cash value product or a product used by corporations and a lot of executives, you will sometimes see cash values that can get as high as 95% in the first year. And there are pros and cons to those high early cash value products, but typically you'll see most policies that generate strong long-term performance credit in the neighborhood of 80 to 90%. A lot of times when we set policies up, you'll see them in that 85 to 88% range, and we're juicing policies for long-term performance and getting as much as we can up front as well. Now, the things to be aware of with a life insurance policy, because you can take a policy and slice it in a million different directions, or a million different ways, I should say. Have you ever seen a whole life insurance policy where you're paying money in and you have zero in the beginning, or maybe 50% of what you paid in, and it takes a long time to break even? Quick side note, if we have 80 to 90% in cash value in the first year, we should typically break even somewhere between 3 and 5 years, depending on the product and company that we're using and such. But here are the items to be aware of. We've got the base premium, term rider, and MEC limit. So the base premium, that is first and foremost going to purchase the whole life insurance death benefit. With a life insurance policy, if I go with a traditional policy, what happens with base premium dollars is first and foremost, it purchases me a death benefit, and you will find in respect to your cash value, 0 of that base premium payment shows up in cash value in the first year, and sometimes the first and second year. Again, this depends on the company and product. My point being, however, is the base premium, the company is going to overcharge me for the death benefit up front. So I see next to nothing in cash value in the early years. As time passes, you will see premium dollars produce cash value or equity in the policy. And why I like to mention that is we hear the word premium, or when you hear the word premium, typically what do you think? Cost. Expense. I'm buying an insurance product. We do have an insurance benefit, but even though it is a premium, you do see it come back to cash value and build equity over time as well. Now, a term insurance rider is a very cost-effective method to purchase more death benefits. Now, you'll see why this is important, because many times we'll work with individuals and they will express, you may have felt the same way, I don't care about the death benefit. Or maybe it does have a play long-term, or it's nice to have, but like, I'm really interested in the cash value, Steve. That's what I want to obtain here. Well, a term rider is a cheap way to raise the death benefit. And why we will often consider a term rider We like to show options with and without, but in the majority of cases, we do use term insurance riders, and the reason why has to do with this MEC limit. So MEC stands for Modified Endowment Contract. A huge benefit to a cash value life insurance policy is what? Safe, liquid, tax-free area to position money. Now, a cash value life insurance policy can lose the tax benefits that the cash value carries. If this happens, well, I should say one way this happens is if we trigger a modified endowment contract. If your life insurance policy becomes a MEC, what happens is that your cash value will still grow tax deferred. However, anything you access, you have to deal with income tax in respect to the gains. And if we are under age 59 and a half, we have to deal with an additional 10% penalty tax. In short, we don't want it. It ruins everything. Now, the nice thing is, what regulates that is the IRS through a MEC limit. And many people are not aware of this. We can actually set that limit wherever we want. You will find that that limit has a direct relationship to an individual's age and total death benefit on a life insurance policy. So as we start to build out a policy, you'll begin to see, okay, here's why the minimum premium, here's why the term insurance rider, here's why the death benefit is important, because it's crucial just to understand enough with that life insurance amount to set our MEC limit where we want it. So let's go over understanding where your money is going. So this is important. We're going to demonstrate this, what we looked at over here on the left, a little bit further. So money can go where? We've got these three areas. The base premium. If I have a base premium of $10,000 per year, and let's assume that I am age 40, depending on the product, that may purchase me north of $500,000 in whole life death benefit. So if you're looking to put $10,000 per year into a policy for a $500,000 death benefit, and you don't care about the death benefit, you'll look at it and say, okay, that premium does not show up in cash value in the first year. Often it does not show up in cash value in the first and second year. As time passes, more and more comes back to equity. However, that's an expensive whole life insurance policy. That's often how whole life insurance is viewed. Now, where I'm going with this, remember that MEC limit. For a age 40 male, $500,000 in whole life insurance may obtain him a MEC limit of approximately $20,000. We'll need to be a little bit higher than that, but going to be about $20,000 in MEC space. That's how much $500,000 of life insurance obtains him. So what this means is if you said, okay, I want the ability to put in $20,000 per year. I don't want to get a bill for $20,000, Steve, but I want the ability to put in $20,000. $500,000 in total life insurance would get you approximately a $20,000 MEC limit. So you could fund up to $20K per year if you're age 40 and have that much life insurance. We're going to show some numbers here as well soon, or in the next video, so you get to see it a bit clearer. But we have a $10,000 premium. So we often talk about a 10/90 split, meaning if I want to pay in $20,000, I would want that premium to be what? $2,000. $2,000 might purchase me $100K in whole life insurance, which might only get me $5,000 in MEC space. So how do I keep my premium low? How do I get it to a minimum and then plow funds into PUAs? That PUA rider is critical in order to accelerate the cash value short-term and long-term, especially when we look at the guaranteed values. We're going to look at the guaranteed values in the next video as well, because that's something that is just always neglected or said, don't worry about it. No, we want to look at the worst case scenario. This way we set expectations properly, because if we approach it guarantees, hey, if it does this bad and I'm happy with it, that's great. if I'm counting on the non-guarantees and it only does what the guarantees do, I'm not going to be happy. We don't want that. So let's assume I want to put in $20,000 per year. $2,000 premium gives me a $5,000 MEC limit. What we will do in this case, going back to the example on the left, is attach a term insurance rider to a policy. This might cost $300 for the year to obtain me another $400,000 in whole life insurance benefits. So what we're doing here is raising the death benefit at a very low cost so I can then keep my base premium at $2,000. So call it my net costs now. Initial costs are the $2,000 premium plus the $300 term insurance rider. Keep that at a minimum. The $2,000 premium gives me a $100,000 whole life insurance death benefit. Let's separate this because I know I've got a lot going on here. Okay. Base premium, $2,000, gives you a $100K whole life insurance policy. Term rider of $300 gives you another $400,000 in life insurance protection for a total of $500K. And again, no, we don't care about the death benefit. What this has to do with, going back to the left, MEC limit, 40-year-old male, $500,000, gives you a MEC limit of $20,000. There we go. So, no, that can be a bit technical. Tried to break it down there thoroughly just to help you understand how the death benefit and MEC limit have a direct relationship to each other. Because the question that you'll likely have and that always comes up is, hey, how do I improve my cash value? How do I get it to the 80 to 90% level? But every time I lower my premium, my MEC limit goes down. I'm told I can't have a lower base premium because then it'll trigger a MEC. Have you ever heard that? So many times we hear that, which is not the case if we have knowledge around term insurance riders and how to properly use them. If you abuse them or if they're not used properly, over time it can become risky. But it's fairly easy to avoid the risk. So, understanding where the money is going is important. Let's take a look here. What we're going to look at in the next video, the case study, will follow everything we just laid out times 5 in respect to the MEC limit. So we've got a 40-year-old male wanting to see a $100,000 MEC limit, or I should state wanting the ability to pay in $100,000 per year, but not commit to it. Wants maximum cash value, flexibility, and then show me the guaranteed value. So we're going to lay out this scenario more so in the next video. Hope this was helpful. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.